Hello again, welcome back to the channel. This is Macro Sunday. Going to talk through some of the economic data coming out this week, some of the cyclical changes going on, a few of my thoughts around the risks coming up in August, and yeah, just have a bit of a chat and prepare for the week ahead. So, thought I would start off by having a look through at the current economic data coming up this week being announced on Tuesday. Key data coming out. We've got consumer confidence, job openings. Wednesday's the big day. We've got GDP, FOMC interest rate decision, and obviously Powell's got his press conference. And then Thursday, initial jobless claims, PCE, and Friday, unemployment rate. So yeah, ISM manufacturing as well. So yeah, huge week ahead for the economic data. So keep your eyes peeled. Any volatility come Wednesday, don't get shaken out. Be prepared. Make sure you're aware of what's coming up. So this is the CME Fed Watch tool. Bit of a change from last week. When I last looked at this, we were at basically 50% of a chance of a cut in September. That's gone up to 62.4 right now, based on what's been happening, I guess, with everything going on with Trump and Powell. Still at 97% for the July cut, so that's basically baked in now. There's no chance that's going to change, I would suggest, given that these are now like forecasts this close to the actual announcement. So yeah, good chance there's going to be a cut come September. So on to the inflation data. So this is the Cleveland Fed's nowcast, where it kind of gives an indication of what they think the next print's going to be. We've currently got in July coming up the 2.73% CPI core at 3.04. Trueflation, it's not huge change since last week. Currently looking at about 2.06% in the US, UK 3.87. Hadn't noticed that. That's pretty significant. The Atlanta Fed GDP print still sitting at about 2.5% for the year, which is again non-recessionary. No concerns there right now. Something to keep watching. Here's the yield curve of the 10-2, continuing uninverted now, and the unemployment rate is remaining fairly stable. It'll be interesting to see what print we get this week, but no sign of recession at the moment in relation to what we've seen in the past. Obviously, you look back over various other periods, you get this acceleration in unemployment following the reinversion of the yield curve. So there's always a time lag between these. And yeah, again, each time recession, unemployment escalates, and yeah, following the reinversion. Same again in 2009. Yeah, nothing at the moment screaming recession. So this is an interesting figure. This is on the UBS website, just showing how that this year they've got something like 6 trillion. I think it's about 9 trillion in total of debt that needs refinancing. But obviously you can see here the bulk of it is in bills at the moment, just because of the fact that been printing on the short end due to where interest rates are, and the fact that we've not been able to bring rates down due to where inflation is. So yeah, interesting times, emerging market kind of conditions, which you wouldn't expect to see from the biggest economy in the world, but this is the world we currently live in. So just to touch on the reverse repo, last week when we had a look at this, we were sitting at about 199 billion, if I remember correctly. So it looks as though we've dropped by about 50 billion in less than a week, because I did that video on the Wednesday. So quite a precipitous drop there. Obviously, the point I made last week, which something I'm watching, is around the fact that if this, or when this drops to zero, the TGA, the Treasury General Account, will start to be refilled directly from bank reserves rather than the RRP, which will be a direct drain on liquidity conditions in the market. I suspect that's what we're starting to see at the moment anyway, where we're seeing risk assets kind of stalling somewhat. I mean, Bitcoin anyway is sat at, it's kind of stalled at the 118 to 123 mark. At the moment, obviously the Nasdaq and whatnot are at all-time highs, but all-time highs in relation to the USD where it sits, which obviously we'll touch on that in a moment. But yeah, so it's something to keep watching, because ultimately, if we get to a point where this drains to zero and come mid-August, the TGA refill, the target refill rates, quantities are somewhere between 650 to 850 billion. Given the fact that they are not, or still quantitative tightening, and the Treasury's hands are somewhat tied in terms of what the quantities that they can put into the market. We're doing short-term issuance at the moment, only at the moment. That there is a chance that they will reduce possibly the target refill from 650 from 850 down to 650. Run the TGA at a lower point through the year, or maybe even just refill a bit later on in the year, just to maintain liquidity conditions in the market. Yeah, so I could be completely off the mark on this one. I've heard various different things. Not everyone is too concerned, but obviously there's always that cyclicality in August of where things start to downtick, and this is one of those years where things do turn somewhat negative through the summer before an end of year Q4 rally. So yeah, we'll keep an eye on it, and I'll report on anything else I know in relation to this. So global liquidity conditions. This is CoinGlass showing BTC global M2 year-on-year money growth and M2 money supply. You can see here indicating the money supply is sitting at about 113 trillion. Obviously, most of that's coming from everyone else but the US, and obviously the US is the most important source of liquidity, being the global reserve currency and whatnot. So obviously at the moment we've got Powell, the Federal Reserve, still carrying out their quantitative tightening of their balance sheet. They're not increasing their supply. The M2 in the US has increased, but I believe this is largely down to bill issuance of the Treasury. So this is where things get a bit nuanced, and obviously Christopher Waller last week mentioned this level, the lowest comfortable level of reserves, sitting at about 2.7 trillion, I believe, which is where they are indicating they'll stop their QT program and then start to potentially expand the balance sheet. This will also still be through bill issuance rather than on the long end, though, so not direct QE expansion. But there may be a chance that QE also happens, and this is what one of the key things to be watching between now and then is this probably the most important chart in relation to bonds, the MOVE index. And yeah, essentially when the MOVE index hits at about 130 to 140, that is when you know the Fed is going to step in and do something. So I've been setting a bunch of alerts to make sure we're watching it in real time, and I'll keep reporting this back to yourselves. But yeah, so that's if you want a forecast of when the Fed's going to start QE again and start increasing liquidity, that will be at about somewhere between 130 and 140 on the MOVE index. So watch the space. DXY is on a secular downtrend, is the feeling that I've been getting from a number of different sources. We have been arguably in what you'd say a potential 10-year uptrend when you go back over the last decade, since 2015, we have been up only, basically. We did have a bounce recently, but then most of those gains have been lost again very recently. Went up to 99 and all the way back down to, there's another 1.8% there. Positioning at the moment is very short on the dollar, which gives one the impression that it's more than likely going to be a bounce, another bounce from here. The contrarian view on that, anyways, is that you won't. When everybody's expecting a move to happen, it's not going to happen, is it? So watch, keep an eye out for that. Don't be overexposed until maybe until the positioning comes off a little. Gold is also retracing somewhat, but still looking very bullish. We were about to break out. It looked like there was an inverted head and shoulders here, but there's been a bit of a retracement recently since there's been the tariff news. Potential deals with Japan and Indonesia and the Philippines, and obviously hopeful trade deal with the EU coming very soon. But we are currently at the point of running out of time. So come the 1st of August, I think there is more than likely to be some volatility where trade deals haven't been reached, and we shall see what happens. This was a really interesting couple of charts that I thought we could run through. We've got the SPX at all-time highs, which is obviously great. Everybody jumping for joy. All risks are off. But when you look at actually where it is now, it's 3.8% above, or maybe I should have done it the other way around, I guess, because that's not how percentages work. But we're about roughly 3.9, 3.8% above the previous all-time high from February, before we had all of this tariff news. But actually, when you look at the SPX in euro terms, it's actually about 8.61% away from its all-time highs, which is an interesting dynamic. You know, the significant loss in the value of the dollar over these months has had a massive impact on. Wow, I mean, obviously it's dollar liquidity positive for everyone else apart from the US, so that's probably part of the reason why we're at all-time highs on a number of risk assets again, as well as the fact that the central banks are printing money. But yeah, we've got the same dynamic obviously with the Nasdaq. It's 4.5% below above where it was before the downturn. And then when you look at that in dollar terms, euro terms, we're actually only 7.36% above, below. We're still 7.36% below where we were. So yeah, I think it's important to try and hedge any long-term investments you may have. If we are in for a secular downturn in the dollar, these long-term, anybody investing long-term in dollar assets, it will continually bleed over the next number of years, however long this downturn occurs for, and there's a good chance it continues because the dynamic has changed. We've moved away from the US hegemon dominance across the world. We're in a multipolar world now. China's trying to step up to the world stage as the US becomes more insular, and equally the euro has been proposed recently, I understand, as a potential global reserve, because now it's a lot more beneficial for the European Union to have that. So yeah, there are some tectonic shifts occurring, and it's crucial that people try and understand as best as they can what's going on and how to hedge against it and protect from these hidden forces, the DXY being one of them. So I highly recommend you review any of your investments you have in these assets and make sure you try and maybe sell and re-hedge, rebuy and hedged, euro hedged, or some other strong asset. The Swiss franc's doing pretty well. to prevent yourself bleeding from these currency downturns. Obviously, that's not financial advice, just educational content only. But yeah, just a suggestion. The IWM looks like it's doing pretty well. Bit of an inverted head and shoulders, which is pretty visible on a number of charts. But the hope is that the August the 1st tariff news is positive. If that continues to be positive in the way it's sounding in the last week or two, then we should start to see a nice rotation out of the mega caps into the small caps, risk on environment back on the cards. And obviously with the potential for the Federal Reserve to start cutting again and potentially even increasing their balance sheet. And ultimately, they have to start increasing their balance sheet in the next 6 months, 5 months. There's about 9 trillion, as I mentioned earlier, that needs refinancing. So all systems go really when you look at it. They've gone from trying to cut and balance the budget to we're going to grow our way out of this mess. So essentially that's the green flag for risk assets. Ultimately it's just getting through the volatility and holding strong, and almost certainly they're going to print the money, which is directly going to flow into all these risk assets and pump the markets. So yeah, this is the world we're in. Another sector to be watching was the VanEck Rare Earth Strategic Metals ETF. Done really well. I'm up considerably on my position in this, and it looks as though it's going to be a continual growth sector, especially the fact that China has the monopoly. I think they hold something like the 90% of the refining and mining of these rare earths and production of the magnets and whatnot that are crucial for military purposes. And it's actually a fascinating dynamic at the moment. It's listening to someone discussing around how actually China are almost forcing world peace on on the global at the moment, where they've turned around and decided they're not going to continue to supply these high-tech magnets, rare earth elements to the US, so they can continue to make these advanced weapons and then potentially turn them on China themselves. See, for China, they are an exporting economy, so they do not want a global war, in my opinion. Obviously, that's at odds with what they want at Taiwan, the reunification of Taiwan, which is something I can potentially discuss in another video. Let me know if you're interested. But at the moment, there's of no benefit to them. They've had a number of years of downturn, and should they go into a war, especially with the US or even proxy wars at the moment, that's essentially economic negative for them. So yeah, they're holding these rare earths at ransom. There's many ways they can avoid supplying them in bulk in the way that they used to. They've gone down a similar route, I believe, that the US has done with the semiconductors, with licensing to certain companies and limiting supply. So yeah, fascinating dynamic. We are in a whole new paradigm, which is something to be constantly aware of and watching and planning accordingly. So yeah, I will bring as much as I can to you in one place in a nice digestible format as if I can. Last one I thought I'd run through. This is the SPDR XLU utilities sector. Again, another potential area where there could be huge growth in the sense that we have this huge rotation from the AI tech manufacturers into the infrastructure to actually grow, provide the infrastructure to actually develop and use the AI tools in the way that they're needed. Something that's absolutely fascinating is when you look at the next biggest power consumer in the world being the United States, producing 4,387 terawatt hours, and then compare that to China, who have been investing in their electricity infrastructure for a number of years, and are now sitting at 10,000, so more than double the electricity generation than the US. And this is an absolutely key metric when you consider the power hungry, requirements of the AI revolution that's coming in. China is best placed to take advantage of this over anybody else. But this brings me back to the previous chart where we have this massive requirement to upgrade the grid in the US after decades of underinvestment. So this is definitely one of the sectors that I think is going to start to outperform when we start to see massive investment from these, probably the mega caps requiring their own electricity grids to power their or to supply their power demands and requirements for the AI revolution coming. So interesting sector to watch, and I'll keep you posted on any developments in that respect. Last thing I just wanted to touch on was the earnings whispers for the week. Obviously Tuesday we got Visa, PayPal, UPS. Wednesday, Meta, Microsoft, Robinhood. Looks like Wednesday, Thursday are going to be big days. HSBC, obviously Thursday, Amazon, Strategy, Coinbase, Reddit, Riot. Wow, yeah, it's going to be an interesting day. MasterCard. So, yeah, that's about it. That's all I wanted to cover for the week. So thanks again for joining me for this run through of the Macro Sunday, Macro View of the week. Hopefully you found it interesting and informative. If you have, please don't forget to like and drop a comment, subscribe if you're interested in these types of videos. And yeah, I look forward to catching you in the next one. Cheers.